Absolutely delighted to have Kiril Sokoloff here with us today. As an investment strategist, Kiril possesses a unique perspective, having been involved in almost every aspect of finance, from commercial banking and hedge fund management to venture capital and private equity. Mr. Sokoloff founded 13D Research in 1983, an independent institutional global research firm. He also authored the book, Is Inflation Ending? Are You Ready? His weekly financial newsletter, What I Learned This Week, has a worldwide following of institutional investors, political leaders, and company executives. Howard Marks wrote that many professional investors include What I Learned This Week from 13D Research among their highest priority reading. Kiril Sokoloff seems more likely than most to cover the big market movers of tomorrow. Mr. Sokoloff is a graduate of Georgetown University. Thank you for joining us today, Mr. Sokoloff.
Well, it's a pleasure to be here.
Excellent.
Your generation is going to be running the world pretty soon.
Thank you so much. Great. So let's dive into the first question, which is, what are your views on the next global reserve currency, or do you believe that the US dollar will maintain that status?
The US dollar has been losing status as a reserve currency for some time. And the confiscation of the Russian foreign exchange reserves, I think, was a crossing of the Rubicon. There's something like 7 trillion US treasuries that are in the balance sheets of foreign central banks. And they have to be thinking about some kind of diversification, most likely into gold or other currencies. So these things happen at the margin, but there's no question that the US reserve currency status is losing emphasis. And over time, especially with Bitcoin and other crypto-backed currency, we definitely see continued erosion.
And so you believe that Bitcoin is here to stay for the longer run, and you're a believer in cryptocurrencies?
Well, I do. I think that, there are obviously many that then a few will survive, but we happen to like Bitcoin the best. And because of its limited supply and its security. And over time, I think it's the one that's going to prevail. But the problem this year has been that crypto has been trading step for step with high valuation tech stocks. So it has not offered a refuge in the storm. And if there ever was a time during the last 2 months when crypto should have come into its own, it was now. And so that's been somewhat troubling from a short-term perspective.
Yeah, absolutely. I think that makes a lot of sense. And speak about your views on how sort of we're going to balance traditional versus renewable energy going forward.
Well, I'm a big believer in the green energy economy. I installed a solar field here in my home in the Bahamas. I was the first really to go all solar, to be an inspiration, but also because I think it's the right thing to do. The problem is that there are 1.4 billion vehicles in the world, and 95% of them use liquid fuel, which means petroleum. And there are only 15 million electric vehicles. So even if you were able to produce 30 or 40 million electric vehicles a year, which you won't be able to for years, and I'll get into that in a second, it's going to take many, many years. Is it 15 years? Is it 20 years? We just don't know. The problem is that there are a lot of bottlenecks. So when it comes to the ingredients for the battery, you have cobalt, you have lithium, you have nickel, and you need copper, of course. And these are all in short supply. These are all rising very sharply for the obvious reasons that they're going to be in big demand. And as a result, last month, Tesla raised prices 3 times. So the gap between the electric vehicle, and the EV is unfortunately increasing, meaning the electric vehicle is becoming significantly more important. Of course, it's a lot cheaper to run. The other problem is that the the capital that's tied up in these existing fleet, 1.4 billion, it's hard to estimate exactly what it is in terms of value, but I would say it's probably $8 or $9 trillion. The average vehicle lasts 16, 17, 18 years, and they're built better, so they last longer. And given the current state of the world, it's going to be difficult for people to trade in. And so this means it's going to take longer than expected. And the problem is that there was great underinvestment in the fossil fuel area. And so now we're faced with the quandary, what do we do? And it's a very unfortunate situation, but it's reality. And of course, the institutions all divested their fossil fuel stocks. It's going to be very hard for them to get back. So far this year, the energy sector has just been hugely bullish and positive. And I suspect that will continue. If my assessment on this is right, that it's going to take this long, 15, 20 years, even 10 years, to where you reach the point that you can start to see a shift. It's going to be really, really problematic. And therefore, OPEC Plus has never had more economic power than they have now. So we find ourselves in a world where we desperately want to go green, but there's so many bottlenecks, we can't get there as fast as we would like. So we're going to have to rely on conventional energy, dirty fuel, for much longer than we had hoped and planned. But there is human ingenuity, and innovation is or necessity is the mother of invention. So maybe some genius somewhere will come up with a solution.
Yeah, absolutely. I think that makes a lot of sense. And throughout your career, what were some pivotal financial or economic events that changed the way you thought about investing?
Well, I study history, and I think it's crucial to be a student of history. So I knew that there was a big cycle of wealth creation, wealth distribution. And many years ago, I identified that we were going into a period of wealth creation. And that enabled me to understand that cutting taxes, deregulating, having a hard currency was going to spread around the world. So obviously it became very bullish in the US. It meant that long-term bonds were going to be great buys at 14%, and that the equity market was going to go up because interest rates were going to keep declining, inflation and costs would come down. So I believed that that would spread across the world, and I basically went around the world investing on that premise. A second was in 1988, I read an article in the Wall Street Journal. It was just a short little paragraph. It said that it took 70 years to build a landline system in the UK, 50 years in the US, 30 years in Japan, 20 years in South Korea. But you could put a mobile phone system in a year and a half. So bingo, the lights went on in my head. And I foresaw that telecom would spread around the world. There would be an internet, there would be access to information, and that there would be eventually billions of people all connected with a smartphone. I didn't see that in 1988, but I understood the immensity of that concept. And as a result of that, I understood how big the internet was going to be. And the internet to me was all of human knowledge available to all of humanity. The problem was that that isn't the way it worked out. A few big tech platforms end up monopolizing the control of information and distribution. But it was a valid premise. And so I was wildly bullish on the internet very early on. I would say another was I was in China for the opening up of China in 1992. And we had been there because we'd invested in Hong Kong telecom because we were investing in global telecom companies because that was the way you were going to do the mobile phone rollout, at least at first. And we discovered that it was the best earnings record in the world for the last 30 years. And it was selling at 5 times earnings with a 5 and 6% dividend yield, just phenomenal valuation. And so we became very interested. And as we got into that, then Deng went to Shenzhen and said, to be rich is glorious. And that was, the world changed for China. And as Napoleon said, China is a sleeping giant. Let her sleep, for when she wakes up, she'll shake the world. And that certainly has happened. So I was there, present at the birth of opening up in China. And I've been to China 100 times. I think I understand China pretty well. So that was a seminal time and moment for me. I would say that one of the things that I've learned is that when things are actually given away, and I mean literally given away, when properties are literally, here are the keys, take it. That is just an extraordinary buy. It doesn't mean that the next month or even the next year you'll start to make money. But over 10 years, you'll make more money than you ever possibly could have anywhere else. And I remember it's just so standard, in the late 70s, the oil companies were making a lot of money and they diversified into metals and mining. And then, of course, because of disinflation and high real rates, and because of Volcker, commodities crashed and the oil companies were suffering. So they divested themselves of these properties that they had bought at huge valuations at basically ridiculous prices. And I had a friend who he was controller for a major oil company. And he basically got the aluminum refinery in Montana for free. He had to agree to accept the liabilities, which I think were maybe $100 million. And within a year and a half, it was throwing off profits of $100 million. I mean, that is so classic. And we had the same cycle again in 1985 when the dollar got incredibly strong. And Caterpillar, for example, the business was so horrible that if you walked into a Caterpillar dealership and say, here are the keys, this is just horrible, I don't want to be in this industry. That was another great example. And then I remember in New York City in 1978, I was walking uptown with somebody from US Trust. And he said, well, today we sold a triplex on East End Avenue. Probably today that's worth $50 million. We sold it for $1 because the trustees deemed that the $3,000 a month maintenance charge was depleting the trust assets. Another classic example. And then in 2015, 2014, 15, 16, the same cycle happened again with the mining industry. The properties that they had bid up in the late 2000s, and their stocks were down, they were hemorrhaging losses. And so they divested a lot of these properties at just giveaway prices. So I think that's a really important, when they're really giving things away. The problem is oftentimes you may not have the money because you're suffering along with everybody else. But if that's not the case, it's just a tremendous opportunity to find value. I think you have to be immensely flexible. And we study markets. And one of my colleagues, who's our chief strategist, basically studies charts all day long. That's all he does. And he's looking for symmetry. He's looking for non-conformations. He's looking for relative strength. He's looking for all the things that charts tell you. And the charts, a picture tells 1,000 words. So we saw that inflation was coming in September of 2020, and we shifted on that basis. And we've understood the current world, which is a structural inflation. and a perfect storm because we study markets and because we are flexible. And it's your biases that kill you. And we all have biases. And if someone said, whoever says that they don't have biases is really crazy, because everybody has biases, no matter how hard you try to get them out. But we come to our analysis of charts with total neutrality and objectivity. And we've been called the agnostic interpreter of what the markets are telling. So it's just that flexibility to change your mind. You don't want to be too changeable, because then you get whipped around. So you have to be some kind of consistency. I'm looking for change that happens after a long period of going in one direction. That's the one that really is meaningful. So 40 years of disinflation, falling interest rates, 19 trillion of sovereign credit with a negative yield, 5,000-year lows in interest rates. I'm looking for a return of inflation. So I was ready to see the markets telling me that it was coming.
Yeah, absolutely. Thank you for that commentary. And also, the net present value of Social Security and Medicare for the next 75 years is projected to exceed tax revenue by about $50 trillion. How do you foresee this playing out?
Well, we studied Japan for 25 years because Japan is the leader of aging population. It was the first country that had peak population, peak working population, the first country really to enter the global baby bust. And I wrote a piece in 1997, which was something titled like More Coffins Than Cradles in 78 Countries. And Japan is an interesting case in point. I think the population fell last year by, I think it was around 600,000, which is just mind-boggling. So it's one thing to have birth rates turn negative, meaning less than 2.2 births per woman, which is where much of the world is now, except for Africa. But it's something else to have the population actually peak. So in Japan, the number, what we call the dependency ratio, the people who are working versus the people who are retired, is set to just skyrocket. It'll be 40% number in 15 or 20 years. And those are demographics, that can be, that's predictable. That's the future that's already happened, so to speak, as Peter Drucker called it. So in the US, it's the same problem. The US isn't aging as fast, and it's got a more youthful workforce. But for many years, the Social Security Trust Fund was generating cash and was used to fund the US budget. Those days are now over. And the last time I looked, there were 10,000 people a day who were going on Social Security. So, how does it all end? Obviously, the promise to pay is going to exceed the ability to pay. And this is a problem that we're going to see all over the world with the aging of the population. And it has to be inflationary, because the only way that you can honor those obligations is with an inflated currency, which is exactly what's going on.
Yeah, absolutely. I think that makes a lot of sense. And talk about how concerned you are with growing levels of debt around the world, please.
I think it's a huge accident waiting to happen. We've never had so much debt. And with interest rates at 5,000-year lows, that's one thing. But when you have the biggest loss in the bond market, as we've had this year since records began, in the 70s, it's massively significant. And I think it's a 1% increase in the US average interest rate on its debt, and interest costs go up like 550 billion. So there are only three ways out of debt. You grow your way out, you default, or you inflate. And I just don't think the world has any appetite for deflating, defaulting, is too disruptive. So the easy solution is to inflate your way up. And if you have very high nominal GDP, so let's say you have 8% inflation in the US, 8.5% inflation, I would argue it's much higher. It's 12 or 15 or 20. But anyway, that's the number that's being used. And you tax some growth on there, you've got some pretty significant nominal increases in GDP. So you could work your way out of the debt burden by inflating. The risk is that you have to keep interest rates down because otherwise your interest costs go up, and then you have to borrow money from the markets or the Fed, as the case may be, to fund interest costs. And that's always a sign of hyperinflation. So this is something we have to watch. And that's why Japan is very interesting, because they are doing yield curve control. They're keeping their interest rates fixed, but the yen has collapsed. And it's been one of the sharpest falls of a major currency that I can remember, and just came out of nowhere. So they can either control the 10-year or they can control the yen, but they can't do both. And this could well be the United States at some point, if for some reason the US Federal Reserve feels it needs to do yield curve control. So what we're looking at is an inflationary world, and we have to learn to invest and live in an inflationary world. And all generations have been living in a disinflationary world. So this means you have to change your approach.
Absolutely. And are there any metals that look interesting to you today?
Well, I like gold. I've liked gold for a long time. It's obviously limited in supply. The central banks own it, while they don't own crypto. So there's an incentive for them to somehow use gold or buy more gold, which they are. The supply of gold is very constrained. We may have seen peak gold, and the sector, the mining sector, is incredibly cheap. And I think 30 top mining companies are worth about 250 billion US market cap, which is really ridiculously low. I like all those EV metals. And let's take copper for a moment. The average electric vehicle uses 80 kilograms of copper. The traditional ICE, internal combustion engine vehicle, uses 20 kilograms. So that's just a massive increase. And while you might be able to find a replacement for cobalt, you might be able to find a modification for lithium. These are years away, and copper is essential for electricity. So I've chosen copper to be my big focus because I think it's the most essential metal for which there is not substitution through innovation. And the bottleneck is just going to be massive. Obviously, you know, the entire commodity sector is in a bull market, and they're all attractive. But the one I've singled out to like the most is copper and gold.
Absolutely. And how do you view artificial intelligence affecting the labor market going forward?
Well, in 1978, 1980, we entered a period where capital was going to be favored over labor. And the last 40 years has essentially in the US been capital taking a greater and greater share out of the GDP from labor. And that is now reversed. And we're actually writing this week about the unionization of many big companies, Amazon, Starbucks, et cetera. And part of this is a result of the shift in society. So for 40 years, it was all profits. Milton Friedman, that's the only real obligation that a company has is profits. Peter Drucker, of course, thought there was the community, the employees, the planet, et cetera. So there's a greater awareness that there has to be a wider and broader focus of what the corporate mind should be doing. So there have been amazing wage increases at the state level and federal level. I mean, there's huge increases. Companies have announced a lot of increases. We also have what's called the Great Resignation, where people in COVID were given a chance to ponder their own life and where they lived and what they did. And I think the number's been somewhere like 7 or 8 million are just making a change, and they're moving somewhere else. They're doing something else. And as a result, there are shortages, and labor itself has just come to understand that it performs a very valuable function. And this trend against labor began really with Margaret Thatcher stealing down the coal workers. And it was like 2 years, the strikes went on, and then she basically won. And it was Ronald Reagan and the air traffic controllers, of course, which is essential for air travel. So these critical jobs in critical places, that was reversed, that you can't, we can beat you. Now, these critical jobs in critical places, they're flexing their power. So let's take nurses, for example. Nurses have been resigning en masse, obviously because they're overworked and their lives have been at risk. And roving nurses are being paid a fortune, something like $10,000 a week, or in some cases, multiple of that. And so in critical places, and it's a truck driver. We don't think about the truck driver as being critical. Well, it is to supply chain. And truck drivers go on strike, ship dockers go on strike, and railway workers go on strike. This can have a massive impact on the economy. So this is all the trends, and I see this going on for a long time. It's all part of my cycle of wealth distribution, which has begun. And it's a slow turn of a giant supertanker, but it's definitely here, and it's going to last.
Yeah, absolutely. I think that makes a lot of sense. And do you believe that we're currently in a bond bubble?
I think that I found it very amusing that bonds were not considered risk assets. I mean, here you have an asset that went up for 40 straight years, was at the lowest valuation in history, 5,000 years of financial history, where 19 trillion of them were yielding negatively, meaning you were going to lose money to maturity. And people would say, this isn't a bubble. I just didn't understand it. So it is a bubble, in my opinion, and it is bursting. Now, the Fed is doing tremendous amount of tightening now. And this is happening when the economy is getting weak and when stimulus checks are ending. And so there's going to be a real squeeze on the consumer side. It's even worse than what we've seen. And so it could be a pretty severe slump. And maybe bond yields come down in that. But I don't know if they're going to come down much, because the inflation rate isn't going to come down too much. And people understand that on the other side of this, the Fed is going to have to do exactly what it's been doing all the way along, is priming the pump. So the old 60-40, which was famous, 60% in equities and 40% in fixed income, that is gone. So all that 40% that's sitting in fixed income is going to be saying, well, what do I do now? And if it comes to be believed that we're going to have structural inflation and that it's here to stay, then that money is going to start to go elsewhere. And the new money that would have come in is not going to come in. So will that go into equities? Will that go into commodities? Where will it go? Because we don't know the answer yet. But there also is the issue of capital losses. So the capital losses in the bond market are just massive. And now we're having really significant equity losses because the FANG stocks are starting to break down, which is where a lot of the wealth was concentrated. So you take these two things, you've got a massive loss of wealth. And there was a former New York governor of the Fed who actually wrote an editorial saying that what you need is negative wealth effect because that will bring inflation down. I've never seen anything like that written by any central banker. It's just astounding. And in the past, I think it was the Japanese and others, let's just prick the bubble a little bit. Well, that isn't the way it works. You know, you either inflation, you don't get it, pregnancy, you don't get a little pregnant, you know, you get pregnant. And when you burst the bond bubble or burst any bubble, there's nothing you can do about putting it back. So we have to watch this play out, but it's considerably dangerous, to put it mildly.
Yeah, absolutely. And do you believe that the increasingly stationary population pyramid in China will cause major issues for their continued development?
Well, I think it's the same problem that we described a little bit about Japan and the world. We have the aging of the population. And if I remember correctly, we have the biggest decline in the adult working population in the 20s, in the 2020s, that we've ever seen since the Industrial Revolution began. It varies from, say, 8% to 12%. We've never seen a decline like this. So we don't really know how it's going to play out. Obviously, technology and robotics and machine learning can help, but a lot of tasks, the most important service function tasks, can't really be automated. So President Xi just announced today a massive plan for investment because a lot of the country is shut down. I think the place to look for what happens when the population goes down and the dependency ratio just soars is Japan. And that's why we continue to study Japan. And what's interesting, coming back again to the yen, is that Japan has been mired in deflation ever since the bubble burst there in 1989. And no matter how hard they tried, they couldn't get inflation. Finally, inflation is picking up over their target of 2%. But it's been a very deflationary country, and the people are very, they wait for prices to come down. To me, what it means is that fiscal stability deteriorates because you have less of a working population, more obligations on the retired side, and that just keeps going. I mean, it isn't something that's going to be 2 or 3 years, it's 20 years, 30 years.
Yeah, absolutely. I think that makes a lot of sense. And what are some permanent changes in the economy that you see resulting from this pandemic?
Well, I think everybody is very happy not to have to travel. I think that's one thing. I think you can do Zooms. Now, if you don't have a relationship, then it's a little harder. But if you do have the relationship, you can have an hour Zoom call, and I think that's definitely permanent. I've lived in beautiful places almost all my career. I chose to live in a beautiful place, whether it was Sun Valley or the Bahamas or South Florida. And there's something about being in nature that appeals to me. And these beautiful places in America have been discovered, and house prices have doubled, and there's no inventory left. because people are making these big moves. I think that is going to be a continued feature, and not going into the office or going to the office for one day a week, but there's huge resistance to go back into an office. People like the freedom, they're more effective at home, they don't have to spend their time commuting. So I think that's definitely a change. I think that the pandemic, there are many psychological and social impacts that we don't yet fully understand. But I think that a lot of people have been traumatized. A lot of younger people have had some really significant problems because they couldn't go to class, and there were the uncertainty of on again, off again, on again, off again. And I think it's added a huge dimension of stress. I keep believing that in the end, we're going to understand that we're all interconnected. And this was one of the things, we studied pandemics for 20 years, so we understand them quite well, even from the very beginning. And it was very easy to see that the pandemic wasn't going to end until you vaccinated the world. Because if Africa wasn't vaccinated, there would be a variant that would come from there that would be impervious to either the vaccines or having caught COVID. And that continues to be the risk. So then we had Omicron, now we have the new variant, which is even more transmissible. So I think, in due course, people will understand we are more interconnected. That doesn't mean that we're going to head for a more interconnected world, because there are also pressures for fragmentation, as we're seeing. And globalization is over. So the tendency is to be more national and more inward looking. So that may not happen. It should happen logically. I also think that not being prepared for the pandemic was a huge tragedy. And it really wasn't a black swan. I mean, anybody who studied pandemics know that it was going to come. And we wrote 100 articles on pandemics between 2000 and the end of 2019. And we created a portfolio of companies that would do well during the pandemic. And they did astronomically well, even before COVID. I think there needs to be an awareness of, you have to look at these risks and you have to prepare for them, and then you watch them. And then maybe you have 20 on your list, and all of a sudden, number 20, you see Wuhan is being closed down. So there's a pandemic. So let's put our pandemic plan into action. There needs to be more of that. And it's my hope that the world will, when all the dust is settled, and says we've got to do better planning, better scenario planning, better thinking ahead.
Yeah, absolutely. Thank you so much. This is a tremendous session. We really appreciate your time, and it was an honor.
I'm very happy to talk to you, and wish you and your fellow students all the best. And we hope next year is a wonderful year with full in-person classes and all the stimulus that you would hope to have.
Thank you so much. Have a great day.
Okay, bye-bye.